3 hours ago, silver miners got absolutely destroyed. A 5% flash correction that wiped out billions in market value in a single session. Spot silver plummeted from over $80 per ounce to $77.93. Major silver mining stocks followed, crashing hard alongside spot prices. And the mainstream narrative? They're calling it a jarring reality check. They're blaming profit taking. But what they're hiding from you is far more sinister. What's really happening is a coordinated Bloomberg Commodity Index rebalancing event that's forcing institutional algorithms to dump positions, regardless of fundamentals. And if you don't understand what that means, if you can't see the manipulation happening in real time, you're about to make the biggest mistake of your trading life. Stay with me, because what I'm about to expose will show you exactly how institutional players use technical market mechanisms to shake out retail investors. By the end of this video, you'll know whether this is the time to panic and sell or the exact moment to load up before the next explosive leg higher. Let me start with the carnage that unfolded today, January 8th, 2026. 3 hours ago, financial content markets and multiple outlets reported a brutal session. Silver suffered a 5% decline in a single Thursday session. That's not normal volatility. That's a flash correction that signals something bigger is happening. Spot silver, which had been trading above $80 just days ago, hitting $80.62 at its recent peak, crashed to $77.93. Gold also declined, trading between $4,300 and $4,400 per ounce, down from $4,488. But here's what makes this absolutely explosive. This wasn't driven by news. There was no fundamental catalyst, no geopolitical event, no economic data release. This was pure technical selling, driven by Bloomberg Commodity Index rebalancing. And most retail investors have no idea what that even means. Let me explain exactly what's happening behind the curtain. The Bloomberg Commodity Index is one of the largest commodity benchmarks tracked by institutional investors worldwide. Billions of dollars in passive investment funds track this index. When the index rebalances, these funds must adjust their holdings to match the new weightings. If silver's weighting decreases in the index, funds must sell silver positions. It doesn't matter if silver is fundamentally strong. It doesn't matter if demand is soaring. The algorithms execute the trades mechanically, creating massive selling pressure that has nothing to do with market fundamentals. This is forced non-discretionary selling. And when you understand this, when you see the 5% crash for what it really is, you realize this isn't a market speaking. This is institutional algorithms executing predetermined trades based on mathematical formulas. And smart money knows that this creates extraordinary buying opportunities. But here's where the story gets even more interesting. This crash is happening right before Friday's jobs report. The non-farm payrolls data drops tomorrow. Markets are nervous. Investors are uncertain. And that uncertainty, combined with technical selling from index rebalancing, creates the perfect storm for a shakeout. Weak hands, retail investors who bought at the highs, leveraged traders who can't handle the volatility, they're all panicking right now. They're selling at $77 after buying at $80. They're locking in losses because they don't understand what's really happening. Meanwhile, institutional buyers who understand market mechanics are quietly accumulating. They're using the forced selling to build positions at artificially depressed prices. This is how wealth transfers happen. From the uninformed to the informed, from the emotional to the disciplined, from weak hands to strong hands. Let me give you some critical context. HSBC, one of the world's largest banks, recently raised their 2026 silver forecast to $68.25. But they warned of volatility. They said the path to higher prices wouldn't be smooth. They predicted exactly the kind of correction we're seeing right now. Reuters reported that gold fell more than 1% on profit-taking. Economic Times noted this is the second consecutive session of declines for precious metals. But notice what they're not discussing. They're not explaining the index rebalancing mechanics. They're not revealing the forced selling. They're giving you simple narratives: profit-taking, volatility, correction. These words explain nothing. They just give you something to blame while the real game plays out behind the scenes. Here's what you need to understand about silver specifically. Silver's fundamentals haven't changed. Industrial demand continues accelerating due to solar panels, electric vehicles, and electronics. Investment demand remains strong as investors seek inflation protection. Central banks aren't buying silver like they buy gold, but private investors are accumulating aggressively. And supply? Silver mining production has been constrained for years. Many of the world's largest silver mines are in decline. New discoveries are rare and expensive. So fundamentally, silver should be going higher. The demand story is intact. The supply story supports higher prices. But short-term technical factors can override fundamentals. That's what we're seeing. Bloomberg Index rebalancing, creating short-term selling pressure that's disconnected from the actual supply-demand fundamentals of the silver market. And mining stocks, they're getting hit even harder than spot silver. When spot prices fall, mining stocks amplify the move on both the upside and downside. A 5% decline in silver can trigger 8 to 12% drops in mining stocks. That's the leveraged nature of equity positions on commodities. But here's the opportunity. If you believe silver's fundamental story remains intact, if you think this correction is technical rather than fundamental, mining stocks are on sale. The companies that mine silver, that have proven reserves, that will benefit from higher silver prices, they're trading at discounts because of forced algorithmic selling. This is where fortunes are made, not by chasing rallies after everyone's already bought, but by having the conviction to buy when prices are falling, when forced selling creates artificial weakness, when algorithms dump positions regardless of value. That's when disciplined investors accumulate. But let me be clear, this isn't financial advice, this is market analysis. You need to make your own decisions based on your risk tolerance and situation. If you're over-leveraged, if you bought on margin, if you can't handle volatility, this correction might force you out regardless of whether you want to sell. That's the reality of trading. You can be right about the direction, but still get stopped out by volatility if you're over-leveraged. But if you're holding physical silver with a long-term perspective, if you understand the fundamental case, this is just noise on your way to much higher prices. Let me walk you through the technical levels that matter right now. $77.93 is where we're currently trading. The critical support level for silver is $75. If we break below that convincingly, we could see $70 tested quickly. Below $70, and we're looking at potentially $68 to $65, which would represent a more significant correction. But if $75 holds, if buying emerges at these levels, this could be the low. We could bounce hard from here. Gold's support is at $4,300. Below that, $4,000 is the major psychological level. If gold breaks $4,000, expect more pain. But if $4,300 holds, if both gold and silver find support here, the rally could resume quickly, catching everyone who sold at the bottom off guard. Tomorrow's jobs report adds another layer of complexity. If the non-farm payrolls number comes in weak, it could trigger risk-off sentiment across all assets. Weak jobs data might initially pressure precious metals as everything sells off, but then it increases the probability of Federal Reserve rate cuts, and rate cuts are bullish for precious metals. Lower rates reduce the opportunity cost of holding non-yielding assets like gold and silver. If jobs data comes in strong, it might support the dollar short term, which could pressure metals further, but strong jobs data reduces recession risk, which means the economy can handle higher rates longer, which means inflation concerns persist, which ultimately supports precious metals. It's complicated. The point is, short-term volatility around data releases doesn't change the long-term fundamental case. It just creates noise that weak hands can't handle. Here's what I'm watching. First, does silver hold $75? That's the line in the sand. Break that, and we likely test lower levels. Second, does gold hold $4,300? If both metals hold these support levels, the correction might be over. Third, how does the market react to tomorrow's jobs data? Does it trigger further selling, or does buying emerge on any weakness? Fourth, do mining stocks stabilize or continue falling? If mining stocks bottom while spot prices are still declining, that's often a leading indicator. Fifth, what happens with the dollar? Is this dollar strength temporary or the beginning of a sustained rally that pressures all commodities? These are the questions that matter, not the panic headlines, not the fear-mongering, not the simple narratives about profit-taking. The investors who understand market mechanics, who can separate signal from noise, who recognize forced selling when they see it, those are the ones who profit. The investors who panic, who sell at the bottom because they can't handle volatility, who buy high and sell low, those are the ones who get destroyed. Let me share some perspective. Every major bull market has violent corrections. The gold bull market from 2000 to 2011 had multiple corrections. Some exceeded 30%. Each time, people declared the bull market over. Each time, gold recovered and made new highs. Silver in 2011 crashed from $49 to $26 in a matter of weeks, a 47% collapse. People thought silver was dead, but the fundamental drivers remained intact. Silver eventually recovered, though it took years. The current correction? We're down from $80.62 to $77.93. That's roughly 3%. 3%! And people are panicking. Imagine what happens if we get a real 10 or 15% correction. The weak hands will be obliterated. But the strong hands, the investors who understand the game, they'll be accumulating all the way down and laughing all the way up. Here's what I'm doing. I'm monitoring those support levels. I'm watching tomorrow's jobs data. I'm tracking dollar strength and index rebalancing completion. I'm not panicking. I'm not selling my core position. The fundamental reasons I own silver haven't changed. Central bank money printing continues. Geopolitical tensions remain elevated. Currency debasement accelerates. Industrial demand for silver grows. Supply constraints persist. Nothing fundamental has changed. What's changed is short-term technical factors. Bloomberg Index rebalancing, profit taking after strong gains. Pre-jobs report nervousness. These are temporary factors. And temporary factors creating price dislocations are opportunities for those disciplined enough to take advantage. Here's my call to action. First, if this analysis helped you understand what's really happening, if you now see through the mainstream panic narrative, hit that like button. Subscribe to this channel because tomorrow I'm breaking down the jobs report reaction. I'll analyze whether this correction is over or just beginning. I'll walk you through the technical levels, the support tests, the dollar dynamics. You don't want to miss these critical updates. Second, comment below. Are you buying this dip? Are you scared? Are you waiting for lower prices? I want to hear your strategy. Third, do not make emotional decisions. This is not the time to panic. This is the time for a disciplined analysis based on data. If your investment thesis hasn't changed, if the reasons you own silver remain valid, short-term volatility is just noise. Fourth, share this video with anyone freaking out about this crash. Help them understand the index rebalancing mechanics and forced selling dynamics. The more people who understand what's really happening, the fewer will panic sell at the bottom and regret it later. 3 hours ago, silver miners crashed 5%. Bloomberg Commodity Index rebalancing triggered a flash correction. Weak hands are panicking. But this isn't the end of the silver bull market. This is a shakeout, a test, a moment that separates informed investors from the crowd. Tomorrow's jobs data could change everything. Stay disciplined. Watch those support levels, and I'll see you in the next update.